What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we will be taking a look at two juggernauts in the cybersecurity space of Palo Alto Networks and Crowdstrike. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you will see within this video are as of market close on April 2nd, 2026. In front of us here, we have the past 12-month price chart for Palo Alto Networks. You can see that shares have declined in that time frame of negative 5.76%. Also, they have had a peak to trough decline of almost 35% and are trading near their 52-week low. Shares are trading just above their 50-day moving average. That is that line you see that is green, but trading below their 200-day moving average. That is that orange line. I want to point your attention to the bottom left that has the 49 analysts that cover the name with an average target price of $207.48. That does imply a 27.1% return if shares do hit their price target. They have earnings per share growth of around 10% per year. That is lower than CrowdStrike that we will see later on in this video, and the company does not pay a dividend as well. You can see that the underlying business is growing at 15.4% sales growth over the past 12 months. Gross margins are 73.5%, above the industry average at 49.2% and above the benchmark at 27.6%. Yet they have had some accounting practices through their recent acquisitions, which we will touch on later, some share dilution, and some depreciation of intellectual property assets, which have shrunk net margins to 13%, below the industry average at 16.7%, yet above the benchmark at 8.4%. Now, when we look at valuation metrics, this is screaming overvalued. The PE over the past 12 months is 90.3. That is incredible, folks. Pretty high price to earnings ratio. Yet what we really want to focus on is the forward PE, which is at 42.1. That is actually lower than their 10-year historical average of the PE, which is around 44 times. Yet even when we look at price to sales, it is still high at 11.7. Now you can see that earnings per share growth that I was just mentioning at 10% over 26 and 27, which is slightly lower than you can see they had a big jump in 22 to 23. So that may be an indication that earnings per share are shrinking in the years to come. Now, Palo Alto recently reported a good quarter with a beat on revenues and adjusted earnings per share, with next-gen securities average recurring revenue growing 33% year over year, while remaining performance obligations grew 23% year over year. Although they delivered a good report, they did trim their adjusted earnings per share guidance for the fiscal year to 365, 370 on account of recent acquisition related costs. Now, they have made 3 major acquisitions over the past 12 months, which do counteract AI threats and are very beneficial for long-term growth of the company. And those 3 acquisitions are CyberArk that were done in July of 2025, Chronosphere in November of 2025, and Koi in February 2026. That said, even though they have a free cash flow of $4 billion, which is, this company is a free cash flow machine, they are doing so by diluting shareholders in these acquisitions. This is not what we want to see on that side. They have a 37 to 40% free cash flow margin, which, if they're issuing equities, they could potentially buy back shares or invest in future research and development. And if we look at one of these acquisitions, we'll look at CyberArk in July of 2025. This was a massive bet on the identity space and security space of cyber and the web. If this is integrated successfully, Palo Alto will own three of the most critical pillars of modern security, that is, network, cloud, and identity. They do hold proprietary software, which gives them a leg up when it comes to large language models potentially threatening the underlying business, as Palo Alto has years and decades of experience dealing with a variety of cybersecurity threats that they can use and integrate to protect and better defend future attacks, whether they're using AI or other large language models. They do offer a better solution with targeting mid-sized businesses, but if there's an economic slowdown, those are the same businesses that get hit the hardest and may cut back on certain costs. And we can see that valuations are still elevated even though shares are trading near their 52-week lows. Here we have CrowdStrike. A different story. Over the past 12 months, it has provided investors a return of 7.44%. Also a peak to trough decline within that time frame of almost 35%, and shares are trading near their 52-week lows. Also, unlike Palo Alto, shares are trading below both the 50-day and the 200-day moving averages. There are three more analysts that cover CrowdStrike, 52, with an average price target of $489.68. That does imply a price target return of 22.7%. That is not bad, but lower than Palo Alto when we're doing that comparison. Although you can see that earnings per share, which is much higher, in fact, Palo Alto's was 10% through 26 and 27, CrowdStrike's earnings per share growth, forecasted earnings per share growth, is around 30%, so 3 times that of Palo Alto. Also doesn't pay a dividend, yet the business is growing even better than Palo Alto at 21.7, above industry and benchmarks averages. Yet you can see that gross margin, which looks phenomenal at 74.5, but they have accelerated their depreciation even more than Palo Alto, which shrinks their net margins to actually negative 3.8%. So poor that their past PE is negative and their forward PE is 78.5 and their price to sales almost 21. From a valuation basis, even though shares are trading after a pullback, they're not the 35%. They have had a bounce, but they are still trading near the 52-week lows, and valuations are still indicating shares are expensive. Now you can see that growth through 26 and 27 of 30% in their EPS. Let's see if management is able to deliver on that. Now, CrowdStrike's single agent architecture remains the gold standard in their space. The Falcon Flex consumption model, which lets customers swap modules on the fly, has seen 120% year-over-year growth. Wow, reaching $1.69 billion in revenue. This creates a massive stickiness without friction of Palo Alto's multi-agent setup. They are also ensuring that 3 major points of attack, unlike Palo Alto, which is looking at the pillars, are covered on their end, and they've done so through their acquisitions of SG&L and Seraphic Security. They control and secure the 3 main points of modern day attacks in identity, browser, and endpoint. CrowdStrike is aggressively stealing market share from legacy players like Splunk with its Falcon Next-Gen SIEM. By processing data at a sub-second latency, they are proving that a security company can run a better data platform than a traditional data company. That is amazing. And it's the first time that CrowdStrike has achieved a positive gap in its full year at 38.7. This silences long-standing bear argument that they've been able to change their or turn their massive growth into positive gap. But if you look at their stock-based compensation, you may see their real earnings are much lower than headlines suggest. And if they, just like Palo Alto, have that integration risk and the synergies, they will have money drained out the door and unexpected costs for no reason. I just want to mention that Microsoft is lurking in the background with its Defender product, offering free or massive discounts with their E5 licenses, even though CrowdStrike is technically superior. Good enough and free is a difficult competitor to beat in a high interest rate environment and macro challenges from tariffs, geopolitical issues, and economic slowdowns, where CFOs, management teams, and business owners are looking more closely at their costs. And if Microsoft is bundling this in their Azure platform and businesses are already paying for the Azure network and paying for the Microsoft Office plethora of products, then companies are going to look at, say, why am I paying CrowdStrike and Palo Alto as well, because they fall into this risk category? Why are we paying for these services when Microsoft, in their Defender offering, is giving this to us essentially for free or at a significant discount, where this can risk the underlying fundamental growth long term for these companies. Again, let's see what the future holds. This is not investment or financial advice. It is just entertainment, and I want to show you guys the numbers. Please do hit the like and subscribe button. It does mean a lot to me, guys. Please, thank you very much. And drop a comment down below. Leave a comment with any company you would like for me to take a look at. Leave the ticker symbol, and I will be more than happy to make a video on it in the future if it makes sense. And we are looking at larger cap companies, not really smaller cap companies on this channel, maybe here and there. But yeah, it's your boy, the Finance Bro, signing out. And thank you so much for joining me today. And stay tuned for the next video.